Hello everyone, how are you doing? I hope all of you are doing good. In today's video, I will be talking about recovering from a stock that is in a loss. So, pretty sure most of us have come to this kind of a situation where we have the stock and then the prices of stock have gone down from where we bought and now they are in red, so we are facing a loss. So in this video I will share what are the three options or three methods by which you can recover the losses on those stocks. Okay, so I'm going to use a real life example here. This is a stock that I bought on April 15th, so around here for $69. I bought 300 shares of the stock, and then I bought it at a price point where there was a demand zone. If you can see, this is a daily chart, and I've drawn a daily demand zone. So from here, the prices did went up all the way up to 77, 78, but I did not sell my stock in there. I was holding it, and then the next day was the earnings. After the earnings, the stock dropped. So it dropped to 64, 63, it all went down to even 62 or lower. So basically, I lost all the profit that I made in the stock because I was holding it through the earnings and the earnings were not good. So this could happen to any stock. There could be a bad news, there could be an earning miss, or there could be something else with the company, and then the stock you're holding comes down. So what do we do in this kind of a situation? So this is what I will be discussing with you. There are three options that we will be looking at and see which one works better. Hopefully you'll be able to get something out of this video, as I found this information to be very useful, and that's the reason I'm making this video and sharing with you. Hopefully you like it. If you do like this video, please subscribe and like it. And if you find any useful information, this really helps us in building this channel. Okay, fast forward, let's move and see what do we have. Okay, here's what I was sharing. So I bought 300 shares at $69. I won't be talking about short selling because in some registered accounts you cannot do a short selling. So I'm not considering short selling to be an option. But then we're looking at option one, option two, and option three. Option one is simply when you have the stock and then when the price falls down, you just sell it and you take your losses, and then we re-enter the market at a later stage. Option two is called dollar cost averaging. What it means is that we hold on to the stock, we do not sell it, but we do have an unrealized $1,800 loss. It's unrealized because we haven't sold it and we are holding on to the stock. So at a certain point level, we go down, we go back and buy more stock. So that's called dollar cost averaging. Now the average cost of our dollar is less. So if I bought 300 shares at 69 and then I buy another 300 shares which are less than 69, then my dollar cost averaging is gonna be lower. So that's what the option two is. Before I move forward, let me ask you a question. Do you think option one, in which you sell the stocks and buy at a later stage, or option two, where you do a dollar cost averaging, is better? In the comment box, let me know what you feel, option one or option two, which is better. And in the end of this video, we will know obviously, which option is better. I'm not talking about option three right now because it's a little bit different than the first two options, but we will look at it at a later stage in this video. Okay. So what happens now, as I mentioned, that our strategy is to see where we should buy back the stock. Now, in order for me to buy back, I need to look at the technical analysis. So for doing that, I was looking at the daily chart. Now I move on to a bigger time scale. So I move on to the monthly chart. So let's look at the monthly chart. So this is the monthly chart of the same stock, and I have drawn my monthly demand zone in here. So the demand zone upper limit is $56.20 and the lower is 45.50. So these are called distal lines and proximal lines if you know how to draw demand and supply zones. If not, then I will encourage you to look at some of the other videos that I have created where I have shared some information about the technical analysis, but I'm also looking at creating a complete set of uh, videos where I will share how to draw demand and supply zones. Okay, so talking about this, so this is the monthly demand zones. My price is, so my target price will be around $56. So when the stock starts coming down close to $56, then right now it's at 63 something. But if it comes down to $56, that's something I will be looking at buying. Okay, this is the monthly chart. Now let's look at the daily, sorry, the weekly chart. This is the weekly chart of the same stock. I have drawn the demand zone for the weekly chart. If you see the demand zone, the darker green color is the weekly and the lighter green color with the purple outline is the monthly. So you see the weekly chart is actually within weekly demand zone is within the monthly demand zone. So we will be looking at the purple line because that's the monthly, so high time frame is better. So we'll be not looking at $52, but we'll be looking at $56 as our first entry target. If it's breached and price do come down close to $53, which is our weekly, then in that case we will be looking at buying the stock at $53. Okay, now that we know our buy point, we are looking at buying around, I would say, $56.50, little higher than what our zones are. So we'll be looking at buying at $56.50, and then be we also want we also want to plan when to sell it because we are already in loss and we wanted to recover our losses and be able to get up the trade with profit. So I do see that the prices where my previous zone was the $68 this zone right here is the zone which where will be acting as a resistance now. So if I draw a line from here, that would be my line of resistance. If stocks starts to move up from here, it will hit this resistance line and it will start coming down. So my target is around $68. So I will buy at 56.50 and then sell at 68. That's the plan. Okay. So this is uh, the plan that I'm sharing with you. So we buy 300 shares at $56.50. We'll look at the chart, how the chart, the daily chart, price chart comes close to our price point. But what I'm sharing is this, our plan is to buy at $56.50, 300 shares, and we will still have a loss of $1,800 because we sold our stocks. In the option 2, where we did not sell our first 300 shares, we bought additional 300 shares for $56.50. Now we have our dollar cost average has come down. At the third one, as I mentioned, later at a later stage. So let's look at the price chart, how the price is moving, and then we'll also look at the next step where we sell our shares. Okay, so let me pull up the chart here. Okay, so this is the chart I was talking about. So this is I will start at the point where I bought my shares. I bought not here, but I bought it on 15. So let's move on to the chart. I'm going to play the chart. So after I bought, you see the prices have started going up, right? And then I did not sell my stock. I was holding on to it. And this is just before the earnings. So the earnings was in next 2 days. I could have sold it for $77. I bought it for 69, sold it for 77. I could have easily got $2,400 profit. So that's like $800 on 3 shares, and I had, sorry, 100 shares, and I had 300 shares. I could have, but you can say my greed or whatever it is, my negligence, that I did not sell these shares. Okay, so this is what happened. After the earnings were not good, and then the stock price came down to almost $62.70 or $63. It did came went down to $60 and 64 cents. So you see there was a huge drop in the price, and this is where we start planning for the next action. Is where should we buy? In option 1, we sell our shares at 63, and then in option 2 we hold on to those shares, and then we are looking at another buying opportunity to recover our losses. So as I mentioned, this is our monthly uh, demand zone. So this is almost at $56.20, but we want to buy a little bit higher. I will set my target at 56.50. We'll watch and see how the price reacts close to it. We are not blindly buying it. We need to look at certain things, because sometimes it may come here, we'll buy it, and then stocks keeps going down. So we wanted to avoid that. We are already in loss. We need to make sure that we do not continue to be in loss. Okay. So as the price moves down, it starts to come down, but it hasn't reached our target yet. So you see the price has started consolidating close to this level, but it hasn't touched it yet. Okay, so I'll stop here. At this candle, it did came down 56.31, and then because it's been consolidating here, right? And then I did bought these shares at $56.50, as I mentioned earlier. In addition to consolidation, there's an other indicator that on this chart that's showing me that it's good to buy the stock. It's safe to buy the stock at this level where it just touched and then it bounced back. Uh, if you can recognize what that indicator is, then do put that in the comments. Tell me what indicator is the one that's suggesting that the prices will move up from here, so it's okay to buy the stock at this price. Okay, so do let me know in the comment box. Okay, let's move now and see how the price reacts after it just touched the monthly demand zone. Okay, the prices have started moving up from here, and then as I mentioned, I have already drawn my resistance line, which is at $68. So I will be selling. I've already put my sell order for $68. So once the price reaches 68, I will sell it. I won't wait for the price to go above the 68 and all the way up to my $69. No, I don't want. That's why in option 1 and option 2 we are choosing a different strategy, because the price will not go up from here. It will continue to fall down. Okay, okay. Price went, touched it, it came down. Okay, it's going up again, a little bit shy of our target. It touched again. So basically, we have already sold our stocks here, because this is where the limit order was, and it was triggered at this point. After the stock came down and it went up, and then it hit the resistance and it started coming down again. Okay, so this is where the stock is right now. Okay, so you see the stock came close to a resistance point 2 times, and then both of the time it dropped from there. So this is based on the technical analysis that we knew how the stock will be reacting. We knew that there is a chance that the stock will bounce back from our monthly demand zone, and then once it starts going up, it will hit the resistance level and it will come down. So We buy here, we sell here. This was our plan. Okay, so now let's look at what happens to our table. Let's go to the table. Okay, so now we sold 300 shares at $68 with option 1. When we bought it at 56.50 and we sold at $68. So our total profit is $3,450. So we have recovered our loss and then we made a profit on it. So we made almost $1,650 profit on the stock. And option 2, we sold our 600 shares at $68. So we got a total profit of $3,150 because our initial capital was higher. We spent $37,650, and this is our profit. Third option is a different one. That's why I wasn't comparing these two options with the third one. The third one is called the call option. So what we do is we hold our 300 shares, then at the same price point, the same day where we bought the shares at $56.50, instead of buying the shares, we buy the three calls for uh, our strike price. Now let's choose what our strike price would be. So as I mentioned that our strike price should be 68, but when I look at the option chain, they didn't had any 68. They had either 65 or $70. So I went with 65 because that would be lower than the 68. If we are looking at a resistance, you are facing a resistance at 68, then the stock price will not go to 70, but 65 it will reach. So that's why I choose the strike of 65. Okay. Okay, here's the option chart. This is 65 strike price and my expiry is 16th of August. The earnings for this stock is in first week of August, so I wanted to choose my call option to expire after the earnings in case if the stock do not move initially, but then if the earnings are positive, then it's going to move up and my call will gain in value. So that's the reason that I chose August 16th, not before, but after the earnings. So close to that date, the options were selling at $270 for 65 strike for 16th of August. Okay, so I bought three contracts of this option, and then as the price started moving up, I sold them at $7, all three contracts. So this is same scenario. We bought the 300 shares and then we sold the 300 shares at 68 strike price. Here what we are doing is we are buying the option and then selling the option at the same time when the stock has moved close to that resistance of 68. Okay, so let's see how the option plays. Selling the 300 shares that we initially bought, but what we do is additionally we buy three calls at $271 as we saw in the option chart, and then we sold those three options for $700, so a total of $2,100. So in that case, we also sold 300 shares at 68, so that gave us a loss of $300. So total we made a profit of $1,800 with our option number 3. Let's look at the summary of the options. So earlier I was talking about three options, but I have added another fourth option. This fourth option is kind of a modified version of the option 3. So option 3 was basically if we hold on to our 300 stocks and then we buy a call, then we do get a rate of return of 8.4%. And compared to option 1 where rate of uh, return on our investment is 16.7. In option 2 it's 8.3, and in option 3 it's 8.4. So if we look at option 1, 2 and 3, we do see that option 1 has a better return on our investment. but I also added option 4. Option 4 is a combination of option 1 and the call. So basically what we do is we sell all our 300 stocks for a loss of $1,800. So we sold the stocks and we have a loss of $1,800. But when the price comes down to where we want to buy it, we buy the calls. Similar to this situation, this option 3, we buy the calls at 271 and we pay $813 as a premium. Now because we have already sold the stocks, now we do not own any stocks. So when the price reaches close to the resistance level, that's where we sell our calls. So our calls are now worth $2,800. So 813 calls are now worth $2,100. So our return on the investment is 258%. Of course, we had a loss of $1,800, and this with this option, we were able to cover $1,800 loss, and we were able to get a $300 profit. Now, the interest return on investment is higher because once we sold our stocks, 300 stocks for $68, all that capital is now free. We could have invested that capital somewhere else. Instead of, in this case, we bought the shares back, but in this option, we are not buying the shares. We are only buying the option, the call option. So we are spending $813 instead of, buying 300 shares at $56.50, right? So the capital required in this particular option is much lower, but the returns are higher. But our profit is only $300 if you remove the $1,800 loss, but the return is higher. So if you look at these one, two, three, four options, you know that there are different ways and combinations that we can utilize depending on your situation. Do you have enough capital? Do you have more than enough capital to put it into your stocks, or you don't have a lot of capital in to put into the stock to recover it? So these are the four options. Depending upon your situation, you can try and test these to see which option is working best for you. But based on return on your investment, you can see how this strategy plays out. As I mentioned, I hope that you learned something from this video. If you liked it, please do share this video with other people and subscribe to my channel. Thank you for watching.